This lecture is an application of project side effects. Specifically, this will be a negative side effect or an example of a substitution when a firm puts a new product or takes on a new activity. Hit pause for a moment and take a second to read the example of the hardware store, and then we'll begin. So when we look at the hardware store, they're trying to expand their business, and they want to do that by opening a gardening shop. And on its own, the gardening shop is probably going to make money and be profitable for the store. But with finance, we want to look at the total effect of the gardening shop. So in other words, is there any way it might damage the sales of the existing hardware store? Now we see the cash flows for doing it, $50,000 a setup and $10,000 a year. So we already have the basic setup for the problem. The issue here is that the new gardening shop will take away some of their parking and hence take away some sales. So we believe that we'll lose sales in an amount of $3,000 per year. Now we need to figure out, should we do the project or not? Now the key idea here with side effects is we always want the net cash flow. So just because it affected sales by $3,000 does not mean that's the cash flow. We need to look at what the firm does with sales. So for every dollar of sales, what does it translate to cash flow? So one easy way to do this is sort of look at the firm's operating margins. Remember what a margin was. A margin was basically out of every dollar of sales what translates to either gross profit or operating profit or net profit. The kind of margin we want here is an operating margin. Remember what operating margin was. It was basically EBIT for the firm, which was earnings before interest and taxes. So how does the firm do prior to paying any investors? So for this firm, their margin is 40%. So out of every dollar of sales, 40 cents is left over before any investors are paid. That's perfect for cash flows. So to measure the side effect, we take the 40% margin times the $3,000 in lost sales. Remember, it's all incremental here. So the gardening shop hurts sales of the hardware store by $1,200 per year. This is a negative. So when we do our cash flow equation, we'll have negative $1,200 for our side effect. Now we're ready to look at our cash flows. For year 0, we invest $50,000. For year 1 and going forward, it's the $10,000 in after-tax cash flows minus the $1,200 side effects. So the net impact of the gardening shop is $8,800 per year. Now the project's 10 years, and here's some cash flow keys to solve this. We compute the NPV at 14%. And we come up with a NPV of negative $4,098. So when you add in the side effect, the project's overall impact hurts the business. And this is the danger. If we had ignored what the gardening shop did to hardware store sales by losing the parking spots, we likely would have accepted this project and done damage to the overall health of our business.